Hey everyone, and welcome. Let me ask you something. Have you ever stared at your screen totally baffled because a trade that looked absolutely perfect just went completely against you? Well, if you have, you are in the right place. Today, we're going to pull back the curtain on a concept called divergence. Think of it as a way to see what the market is really planning to do next. It's a game changer, especially for avoiding those common, painful trading mistakes. This quote, man, it just hits home for so many people. It really gets to a painful truth, right? When you're just starting out, it feels like price is everything. But what if I told you the price can lie? That's the big idea we're going to dig into today, how to read between the lines of a price chart and find the real story. So here's our roadmap. First, we'll talk about why price charts can be so misleading. Then, we'll define our secret weapon, divergence. After that, we'll get hands-on and learn how to spot it with two super popular tools, the RSI and the MACD. And finally, we'll wrap it all up with a simple step-by-step trading plan you can actually use. Okay, so let's get right to it. Why do so many new traders get wiped out? A lot of the time, it's because they're taking the price chart at face value. They see the price pushing up to a new high and they think, awesome, this trend is super strong, I'm jumping in. But what if the engine behind that move, the momentum, is actually running out of gas? That's the mixed signal that catches people by surprise. And that leads us perfectly into our main topic, divergence. Honestly, the best way to think about it is like having X-ray vision for the market. It lets you look right past the price on the surface and see the real strength or weakness of a trend underneath. It's all about revealing the momentum that's really in control. So, at its very heart, divergence is simply a conflict. It's a disagreement. It's when the price is doing one thing, let's say making a brand new high, but your momentum indicator is doing the complete opposite, like making a lower high. It's this clash between what you see on the price chart and what's happening under the hood that gives you a massive clue that something's about to change. Now, this is super important to get. Divergence isn't just one signal. It actually comes in two main families. Think of it like this. Regular divergence is your reversal signal. It's trying to predict when a trend is about to run out of steam and turn around. Then you have hitting divergence, which is the opposite. It's a continuation signal. It helps you confirm that the current trend is still strong and likely to keep going. All right, let's get practical. How do we actually spot these patterns on a chart? Well, our first tool is going to be the Relative Strength Index, or RSI. It's a total classic, a fantastic momentum indicator, and it's absolutely perfect for learning how to spot divergence. Okay, now before you just slap a standard RSI in your chart, we need to make one tiny change. We're going to adjust both the upper and lower bands to 50. Now, why are we doing this? It's because we're not going to use the RSI for the old overbought or oversold signals. No. For this strategy, we're using it as a pure momentum gauge. Is momentum above the 50 center line, or is it below? That's it. That's all we care about. And this right here, this is your new best friend. Seriously, you might want to screenshot this. Let's just walk through one example so it clicks. Look at regular bullish. The price makes a lower low, but at the same time, the RSI makes a higher low. See that disagreement? That tells you that the sellers are getting exhausted and the trend might be about to reverse back up. That same simple logic, that conflict, applies to all four of these patterns. Now, here is a pro tip that will save you a ton of frustration, especially when you're hunting for those big trend reversals. So, you spot divergence. Great, but don't just jump in feet first. Be patient. Draw a simple trend line on your price chart, and then you wait. Your real entry signal is when the price actually breaks through that line. It's like the market giving you the final green light to take the trade. All right, next up we have another powerhouse indicator, the MACD. That stands for Moving Average Convergence Divergence. It sounds complicated, but it's another fantastic tool that gives us a slightly different and sometimes even more powerful way to confirm these divergent signals. I know, the MACD can look like a crazy science experiment down there at the bottom of your chart. But the idea is actually pretty simple. All it's doing is tracking the relationship between a fast-moving average and a slow-moving one. The histogram, those little bars, is just a visual shortcut to show you how far apart those two lines are. Bigger bars means stronger momentum. That's really all there is to it. Here is a simple little rule for the MACD that is incredibly effective at keeping you on the right side of the market. Just use the zero line as your filter. If the MACD is trading above that zero line, the overall momentum is bullish, so you should only be looking for buys. And if it's below the zero line, guess what? Momentum is bearish, so you only look for sells. Easy, right? And here it is. This is arguably the most powerful signal you can get from the MACD. We call it a double divergence. This is when you see the divergence pattern show up not just once, but twice. You'll see it on the histogram bars, and you'll see the exact same pattern on the MACD lines themselves. When you see both parts of the indicator agreeing like that, that's a high probability signal that momentum is making a major shift.
Okay, so theory is great, but let's get down to brass tacks. How do we actually use all this to make a trade? Let's put everything we've talked about into a simple, actionable plan that you can start practicing with today.
This is your entire framework right here. Step 1. Stick to higher time frames, like the 1-hour chart or even higher. It just filters out so much random noise. Step 2. Go hunting for your divergence pattern. Step 3, and this is the hardest part, be patient. Wait for that confirmation signal we talked about. And finally, step 4, know your exit strategy before you even get in. A simple 1-to-2 risk-reward ratio is a fantastic starting point for building good habits.
All right, let's bring it all home. We're going to boil all of this down to the most important takeaways. Think of these as the golden rules that are going to form the foundation of your entire divergence trading strategy. Look, these aren't just suggestions, these are the habits you need to build. Use higher time frames for clarity. Use hidden divergence to trade with a trend. Practice patience and wait for confirmation. And always, always manage your risk with discipline. If you can internalize these principles, you'll be trading so much smarter. So, the next time you pull up a chart, I want you to ask yourself this one question. Don't just stare at the price candles going up and down. Look deeper. Look for the momentum underneath. See the disagreement. Understand that conflict. And you will start to see the real story the market is trying to tell you.